that you have to trade options around earnings or that you shouldn't trade options around earnings. It's just that there's certain things you should be aware of in terms of how volatility tends to behave, the concept of expectation versus reality. So we'll be talking about, again, a lot of these different concepts, but please, at the bottom of your screen, if you see that question, answer, or Q&A feature, please be comfortable using that, asking us any and all questions. We're happy to be helpful during this time as much as we can. We're going to spend about an hour or so again on this session. So we'll talk about some general concepts, some general types of foundational keys to keep in mind, and then we'll have some time for demo. If you have a ticker symbol, maybe there's a specific company that's announcing earnings that you're interested in. If we have some time, we could use that in terms of what we use for our live demonstration portion of today's session. So I'll go ahead, just leave the disclosures up for a moment. But Nick, when we talk about earnings, we talk about trading options around earnings. Again, what comes into my mind is this idea of expectation versus reality. Is the price of a stock is reality. It's trading at where it's trading at. We can have an opinion on it. We can say, hey, I think the stock's going to go up in the future. I think it's going to go down in the future. And then the options market gives us this way of understanding what's the expectation for the future. A lot of times there's certain companies that when they are going into earnings, there's, okay, this could be a make or break quarter, or sometimes this could be maybe there's kind of a mix. And hey, if the numbers are bad, it's not going to be that bad. If the numbers are good, maybe they're not going to be that great. So sometimes there can be a little bit of a lull. And so, okay, if that's what we're expecting, well, if that happens, that's fine. But maybe we're expecting one outcome and then the opposite happens. And part of the benefit that all our clients get today is I've been on the right side, I've been on the wrong side of some of these trades. You've been trading longer than I have, so I'm sure you've seen a lot of different scenarios where you've been caught on the right side, caught on the wrong side. So at the end of the day, what we're trying to do is equip everyone, make sure everyone's aware of some of these big concepts. So before we get started, and Nick, I'll definitely welcome your thoughts on the matter. Just a reminder for anyone who's brand new to options, or if some of today's topics or content goes a little over your head, so to speak, I want to point out that you can go to fidelity.com on the news and research tab. If you go down to where it says learn, left-hand side, you'll see events. We do have formal each month classes. We have both the beginner and an intermediate level class. In terms of this session's topic, it's going to really kind of tie into that week 1, week 2 intermediate level discussions, where we talk about things like Greeks, implied volatility, pricing, stuff like that. If you're interested in some of our other sessions, or you're wondering what else we do, if this is the first session you've ever attended of our team, certainly welcome. We would certainly encourage you to check out our coaching page and check out, our daily market briefings and some of the other content that we have as well. In addition to options, we do a lot of tool-based demo. We talk a lot about technical analysis, so I'm sure that can be helpful for you as well. But Nick, just getting started, maybe you want to just kind of open us up, share some of your thoughts in terms of implied volatility, in terms of trading around earnings. I know there's a lot of companies that are announcing earnings this week.
I had to find the unmute button. Yeah, there's so much that we can talk about when it comes to earnings this week, especially as we jump into the thick of things of earnings season. To me, earnings season really started to kick off about 3 weeks ago, where we had Federal Express announce their earnings. They provide a little bit of an insight into what might be to come. Other traders I know, I believe it's James on our desk. He really considers Delta. When Delta announces, that's kind of the kickoff of earnings season. And Delta announced last Thursday, followed by a slew of the big banking names on Friday. We then had a lot of the other banking names this morning, Goldman Sachs, BlackRock, and such, to kind of round that out. And we'll even get some more tomorrow. We'll have Bank of America coming up tomorrow. Interactive Brokers after the close as well, a little bit of kind of a competitor from a brokerage standpoint. But we're really starting to see, in addition to some of the other names, we're starting to then see some of those bigger names at the end of the week, Netflix and such. And I do want to show and step through and talk about some of those things as real life examples. And I'd like to kind of ask the audience that if there's a particular thing that you'd like us to look at with those companies, a particular trade you had in mind, let us know and we'll start to build that out within Active Trader Pro. But that said, kind of building over into what Troy was talking about, I do think it's really important to talk a little bit about volatility, historical volatility versus implied volatility. Now, we're going to assume some base level knowledge. We're going to start to get into some of the Greeks here. We're going to assume you've had some exposure to this, but I think it's really, really important that we bring it up again because when you're trading option on earnings, these are some of the more complex types of option trades you can place because you're really, really, really you're making money. If it doesn't, it stays flat, you don't lose anything. You don't make anything, you don't lose anything. And if it drops, you lose money. With options in the hand, if you say, hey, I think this is going to go up $1, and you buy an option, you could lose your shirt because maybe the options market's pricing in a $5. Well, if it only moves $1, well, you're going to lose because of this gets back into expected movement, magnitude of movement, implied volatility. So, of course, historic volatility is going to be looking at the past, what the stock has actually done. Now, we do have some really nifty tools that we have access to that I want to share that can also show, historically what a security's done around earnings. And I have some screenshots courtesy of friends over at LiveVol. But historical volatility is really just the day-to-day of what the stock has done day-to-day in the past, the last 10 trading days, 20 trading days, 30, 60 trading days, and so on. Implied is what the security is expected to do in the future. And this is derived off options pricing. So in essence, if you or I, the market out there, feel that an option is undervalued, what might we do? Well, just like if a stock is undervalued, we might buy it. If we feel an option is overvalued, well, we might sell it, short it, so to speak. So there's a balance there between the buyers and sellers, the longs and the shorts of a particular value. Now, based on that value, you plug that into an equation, Black-Scholes binomial. You have all these constants and such. You have what the stock price is trading at. You have the strike price, time expiration of the dividends, etc. What are interest rates at? Plug all these constants in there, and you're going to be then left with two unknown variables. And what these unknown variables are going to be is one unknown variable is going to be what the option premium is, and the second unknown variable is going to be volatility. Well, if you take your expected movement in the future and plug in this equation, you're going to get your theoretical value of what you think the option should theoretically be worth, which might be higher or lower than what the market's pricing it. On the flip side, if you take the market's premium and plug it in the equation, you're going to get the volatility implied by the market. That's where implied volatility comes from, and such. And so it's the 30, 60, 90 days is based on an option hypothetically expiring in 30, 60, or 90 days, because there might not be one that does it exactly 30 days. Maybe it's 25 days and 32 days, and it's kind of blended to be that, if it's weeklies, or maybe it's 15 days and 45 days if they're monthlies and such. But there's a lot of tools out there that will find one theoretically expiring in 30 days, base it off of that. We'll base it off of, two above the money, two below the money. They might use, 4 strikes there on the call side and the put side, or maybe some will go 4 up and 4 down. They use 8 strikes on the call side and the put side. Some measures a lot more complex than that, like the CBOE's volatility index based on the S&P 500. It's a form of implied volatility, but they use a lot of strikes, and they use so many start to get some skew in that. And so with this magnitude of movement, these expectations, I really, really, really remember, vividly remember, I should say, in college, uh, I was taking some mathematics classes, and I hit those upper level math classes and just hated the math theory classes. And one of the classes I hated the most was I hated statistics. As a mathematics major, I had to have a two senior level stats class, a part one and a part two. I couldn't get away with just the sophomore level business stat. I had to have senior stats for mathematicians. And I remember I was in the second semester and I was like, when am I ever going to utilize calculations for a 33-year rainfall? Is this the 28-year versus the 33-year rainfall and a 100-year flame? When am I ever going to use this information? And I was just like, this is worthless, until I started trading options. And it's like a light bulb went off, with these statistics. I was like, this is where it's useful. Is this statistical analysis, and as such, I've done a lot more in Z tests and students T tests and all those other stat stuff. I've done a lot more with that, but it comes down to on a very basic level. I'm sure many of you remember that bell curve from high school math. Well, a bell curve, you have that standard deviation of that distribution of where you're expecting outcomes to lie. Implied volatility is in essence showing you what the market is expecting that standard deviation to be. And so in essence, if we have an IV 30, it's expecting results to be, plus or minus that percent in 1 year to one standard deviation, which means 68% of the outcomes will be within that. Now, rounding a little bit, 95% of the outcomes will be plus or minus 2 standard deviations. And as such, now we're able to quantify expectations. Now, again, these are now annualized numbers, and they are less important to us on an annualized basis. We're looking at, earnings now that happens tomorrow. What about 1 day? What about 1 week? Well, there's some complex mathematical equations that you can leverage that will actually convert these numbers from an annualized basis to a daily basis, or a weekly basis, or a monthly basis. Some of the basic math here is if you have days to expiration be 1. Well, square root of 1 is 1. How many trading days in a year are there? About 252. Well, many traders are around that to 256. Pretty close. Well, why do they do that? Well, square root of 256 is a nice round 16. So with this, you get a standard deviation move being the stock price times implied volatility times 1 divided by 16. Or really, you can get a percentage move by just taking implied volatility and dividing it by 16. So kind of coming back here, this 62% IV 30, divide that by 16, correlates with roughly a 4% 1-day expected move. Now we're getting somewhere, especially when it comes to earnings. And so where this becomes important is, let's say you're expecting a 2% move. Well, the market's expecting a 4% move, which then means that you're expecting less movement in the market, as you should be a volatility seller. The flip side is you've done the math and gone, oh, okay, I expect a $12 move and it's a $150 stock, so a $12 move is an 8% move. And the market's pricing a 4% move. Well, now you're actually expecting more movement in the market. So you should be a volatility buyer. And this is where this kind of comes into play with this. And there's different math for different time frames. We can shift over, and based on that day is 1 day square root of 1 is 1. Well, if you look at 4 days, just about a week, has some earnings coming up on Thursday. Well, square root of 4 is 2. 2 divided by 16 is 1/8. So divide volatility by 8, you get a 4-day expected move. If you multiply it, so to speak, it might be a little bit easier with this as opposed to 2/16, 3/16. Multiply by 3, divide by 16. Well, now you're going to get a 9-day expected move. And if you do it by 4/16, which is about a quarter, divide it by 4, you're going to get a 16-day expected move, which is just over a week. I'm sorry, not a week, just over 3 weeks on there. And as you get beyond that, you get to a month. Well, really, the math starts to work out better. That as opposed to trying to be simple with it, you just take, well, what's the square root of 1/12? 1 month out of 12, kind of things with that. And you just pull out a calculator and you can run those calculations and such. But this is the big, big, big thing I was addressing here, is having the ability to compare your expectations to market expectations. And if you expect a bigger move, you're going to be an option buyer. It's going to push up demand for options contracts, leading to more premiums, higher implied volatility. The flip side, if you are a seller. Now, that said, there's a lot that I know that I've covered on implied volatility. I haven't seen any questions that come in to play yet, but I would like to start to address a little bit about how we have a little bit of the rush and crush of implied volatility. And that's before we start to get in some of the screenshots I have on expectations based on that. Now, that said, Troy, there's a lot I know that I've talked about that I kind of touched on. I was skipping around here, addressing with everyone on implied volatility versus historic volatility, kind of setting the stage here a little bit. That said, is there anything that you might want to elaborate on a little bit on what I've talked about? Or is there something you might want to share on maybe this graphic, or should we shift over to ActiveTrader Pro? What kind of jumps out to you that those in our audience might need to know as we get started talking about trading option on earnings?
Yeah, Nick, appreciate all what you've shared so far. I think volatility or implied volatility is really kind of that hard thing for a lot of option traders to kind of wrap their mind around. So think about this, right? From a trading perspective, you might say, oh my gosh, there's so much theory, all these pictures. How does this really impact me? And why it does is what's priced in versus what's not priced in. As a trader, we're always looking for opportunities. So we want to evaluate kind of both sides. And a lot of times we can kind of have these, maybe sort of binary like scenarios. And so there can be times where the expectations are just so heavily skewed to one outcome. Now, could that expectation be correct? Oftentimes it is. The expectation is there for usually some kind of a good reason. The market's a pricing mechanism. There's kind of this debate of how effective it is. I think we can have academic disagreements, but the idea is a pricing mechanism nonetheless. So, in terms of why this matters, and we're going to get into the nitty gritty, in just a few minutes here, but why this matters is when we're approaching earnings, and if it's expected to be, hey, this is a huge quarter, and sometimes, again, what's the other side of that trade look like? And from a trading, at least how my mind kind of works, is I'm looking at and I'm thinking about risk reward. I'm also thinking about probability of success. And again, some of this we can look at, we can use tools to kind of gauge actual probabilities or based on certain assumptions, I should say. Or we can say, hey, maybe there's, maybe a 50-50 chance I'm right or wrong. And we could say, all right, if the market or the expectation is so skewed to one outcome, could there be a slightly different outcome that could lead to some type of a profitable trade? So I'm sure you got some really good screenshots. I think we want to kind of go deeper into this topic, Nick. But just as an example, I thought I'd just share this on ActiveTrader Pro, and I'll definitely turn it back over to you for kind of a deeper dive into this. But Netflix, as an example, and I think we got another ticker symbol that we can look at shortly too. And I think you got a really good graphic that kind of shows this, Nick. But we can see here's a 1 year chart or so of Netflix. And all I've done here is shown the 30-day implied volatility as an understudy. And we can see that there are times where price is doing one thing, but what's really constant is you talked about that rush and crush. It's an absolutely very well-defined concept. We can look at all these blue lines or
Yeah.
turquoise lines, and we can see what happens to IV. It does have that rush and crush. So that's a concept that we need to be aware about. Now, here's kind of another thought with that is that just means that the pricing or the premium, there's going to be a valuation compression to options. So that's just one side of the coin. That's the IV aspect. What does price actually do? Well, for example, if we look here, let's look at, and again, we're using the benefit of hindsight. This is back towards beginning of this year, around January 22nd, 23rd or so. Well, you can see implied volatility was a little bit elevated, right at about the 40% of the, again, IV30 options. And that was a little bit higher than where it had been for the last, maybe 15, 20 days, where it was down here in maybe like the mid high 20s, right? So now we see IV is elevated. Now, right after earnings, you get the crush. It goes from about 44 down to about 27. That's a pretty big IV crush. Think of that. And again, this is not always the perfect analogy, but think of it like a PE on a stock, right? The valuation goes down, but what's the actual performance of the stock? In other words, here, the valuation goes down on those options that were going to expire shortly after this event that's a catalyst. It's an unknown, and now it becomes a known. So there's less kind of uncertainty. And we know that uncertainty a lot of times builds that expectation in terms of elevating the short-term price of options. But the price actually gapped higher and pushed higher shortly after this earnings. So let's look at where price is. This isn't perfect, but price gapped up about, maybe about 9, maybe 10% or so. So let's think about that from a strategy perspective. If you went long options, those options were expensive. Let's say we were trading at, and again, I'm just throwing out numbers. I don't have any historical data that I dug up, but we can see Netflix was trading at about mid-high 490s. Let's say you bought a, 520 call and you paid $10 for it. That means you had a break even at about 530. Well, the stock opened at 537. So even though you have a valuation compression, right? So there was a lot of juice in those options, the juice comes out, but you had a favorable price movement based on your strategy. If you were long a call, that's a super bullish strategy. You get the valuation compression, but you got the favorable price movement. So this is one scenario where even though vol works against you, price, if you were, again, doing a bullish strategy, price gave you what you wanted. And so even though you had one factor that was a drag on your trade, you had that favorable price movement. Let's look at a different scenario. For example, if we scroll back here, let's say you were super bullish. Well, you got kind of the double whammy. You got the vol crush. IV30 was about 50 or 51. And shortly after, it went down to about 34. You lost about half of your vol value there, maybe a little bit less than half. Now, not only did you not get the favorable price if you were bullish, you got bearish to lower. So those are, if you were, again, looking at the price where it was at, maybe the high was 485 the session low was about 470. So let's say you bought the 500 call, you paid $10. Well, it opened, that call was going to be worth a big fat goose egg. So that trade completely evaporated. And there can be times where you get a little bit of a mix. So vol is almost always on a before and after basis. It's going to work against you. Now you have to think about what are those other strategy considerations based on what type of trade you're putting on. We're going to talk about things like a straddle, where we look at both the high-low pricing expectation, but could you have done Catherine made a comment I know earlier on, Nick, in the chat saying, hey, there's times where, maybe do we want to sell some of this volatility? Maybe sell a put, maybe use that as a way to enter into a stock position. Hey, I'd be willing to buy it if it dipped. And on a short-term basis, those option prices tend to be elevated, which could be attractive from a selling perspective. But we need to also consider the asymmetric risk reward dynamic is that there's a low probability there could be a very unfavorable price movement. It may be a low probability, but it could have a high loss implication depending on where we structure our trade. And we have to kind of think about, are we doing this as a trade in a vacuum versus are we approaching this or treating it as maybe a longer term, investment? If I sold a put on Netflix before this earnings this was July of 23, it was trading at, the low was 470. Let's say towards the low of the session, maybe at 475, maybe I was bold and I thought, hey, I'm going to sell the 460 put and I'm going to sell it for $5. So that would mean we would break even 460 put for $5, about 455. Well, we opened the next day, we opened at 447. So we opened below that. So we instantaneously now have an intrinsic loss on our hands. Again, this was actually a period of a downtrend. So again, we would have a position at a loss. Are we going to buy to close that put and just treat it as a bad trade? Or are we going to take assignment, hold the stock, and then just be patient? What's our plan going into that? Netflix actually was in a short-term downtrend. And then eventually, after its next earnings, you had the same crush, but now you have a gap up, push higher, and this was the beginning of a much longer type of run higher to where we are now. So again, those are just some initial thoughts, Nick. I know you have some screenshots and some other things to share, but the vol crush is pretty much a consistent. What we don't know is where is price going to go, and again, what type of strategy in terms of a straddle, in terms of selling a put. Maybe we want to sell an out of the money call. Maybe we want to buy a put if we're hedging a long stock position. There's a lot of different strategies, but we have to kind of think about how do those strategies relate to these basic concepts of changes to vol and price movement.
Absolutely. Something I'd really like the chart you have pulled up, and something I'd like for you to add to that chart is could you actually add on historic volatility on that understudy that you have? And this is a really neat tool that we have. You can add in historic volatility, you can add implied volatility. And what this will actually show is some of the differences here that you could really see, as Troy was saying, the rush and crush of volatility. What doing this illustrates is like that earnings announcement that happened in October, the end of October there. We see elevated implied volatility. And then once the date happened, big movement in price. But even though there's a big movement in price, what happened to expected future movement? Boom, it dropped down because the event already occurred. But we then had a leg up and historic volatility. Historic volatility shot way up because now we actually have a built-in past move into historic volatility. And then, of course, 20 trading days later, that one big move was no longer in the data and everything drops back down to normal. Then we fast forward a little bit until we're roughly 30 days before the next earnings announcement, and we see implied volatility go up again, pricing in that expectation for a larger than just a regular day move in that. Now, one thing I want to draw everyone's attention to with this is I have a lot of traders that want to, buy an option with the expectation, hey, we're going to see a rush of implied volatility. Let me buy an option and I'll sell it a couple days before earnings and profit off of this change. Well, unfortunately, it didn't quite happen like that. And if you could, Troy, remove historic volatility 20 and add IV 60 on the realm for us. And the reason why I'm having Troy do this is now that we have IV 60 on here, IV versus implied volatility versus historic volatility. I'm sorry. So we want IV 30 and IV 60. No historic volatility. There we go. And what this will show is, we can see now 60 days out, it starts to creep up a little bit more. And so we'll have some traders that they might buy an option 40 days out because, well, IV 30 is lower. Well, it's because IV 30 is a hypothetical option expiring before the earnings. But the actual option that expires after is already going to have that built in there. And if we were to then pull up an option chain on something that has earnings coming out in 45 days or something like that, we could really, really clearly see some of those differences with that. So the traders that will purchase an option earlier on, well, that's already starting to be priced into that. Not only that, but yes, the day before we have an earnings announcement, yes, you will see a much, much higher implied volatility than you might normally would. And there is a basis here with gains due to Vega and such. But what will really happen here is, let's say time decay is 5 cents per day. And, Vega is 0.01. So every 1 cent change in the option or 1% change in implied volatility is a 1 cent change in the option. Well, what happens if from one day to the next, price stays the same, but the option drops from $1 to 97 cents? Time decay says it should have dropped from $1.95, but it dropped from $1.97. So what must have happened? Well, implied volatility must have gone up 3 points due to the Vega. And then the next day, it drops from 97 to 95. Well, should have dropped 5 cents. Well, implied volatility must have gone up 2 more points. And so you'll wind up happening that work with traders, they'll buy an option looking to profit off that increase in implied volatility, and really they don't profit off of that. They just don't lose as much money due to time decay. And if they make money, it's then because of delta. It's then because of directionality of the security. And so, Troy, I'm just going to steal the screen real quick. I want to share an option chain, and I'm going to share an option chain on. We'll start with Bank of America, and we can really see some of these differences on here, and on where implied volatility is now. So Bank of America is expected to announce earnings soon, and we can see a much higher IV 43 for the option expiring this Friday compared to IV 30 is 24. And we can see then the one after that, the one next Friday, 31, 27, and so on as it drops down until really, if I remove these weeklies, and let's say we look at this one that's much longer term. This is December of 2026. It's going out over 2 years. Well, with something like this, traders of this option, they're not really going to care about earnings this week because there's going to be at least 8 more earnings between now and when this option expires. And so these much longer term options they're not really going to be impacted by the short term. And we had a couple questions on that about, if I have some longer term options, you have a longer term call expiring at the end of the year, how is IV crush going to impact things? Well, if we look at this, we can see, well, this option, its implied volatility hasn't really gone up for that at all. And let me shift over and we'll look at, we'll pull up Microsoft real quick. turn weeklies back on. And I'm doing this because, Microsoft expected to announce next week on the 23rd. Well, here we have July 19th, this Friday, 22%. I'm just going to shift this over to 5 strikes real quick. 22, 23% implied volatility for this Friday, not including earnings. And not really that much of a jump on this. So we really would have expected this to be a little bit more. This might be a little bit of shift. Let's look at another company real quick. There might be a little bit of a missed date on that. So you see a little bit of a lift here in Apple, going from 23 to 30, back down on that particular basis. And for a lot of these other ones, I know NVIDIA is going to be quite a bit more time away. We're asked if we could take a look at NVIDIA. NVIDIA has almost 6 weeks at that time, 39 days away, but it's still expecting a lot of movement between now and then. So it doesn't really have that lift, so to speak, that you might expect. But what traders will notice, we shift over here to Netflix, is have this 100% almost implied volatility, but then it drops down and it drops down. As we get further out to this December, well, this December is really more about that normal level. Look at December of the next year. So it's really about that 35, 36 going out to December or even the next December. And so what a trader might look at this is after earnings happens, that this August one might then crush down from 47 to 36%. The July 19th one might crush down from 99 to 36%. Now, given once earnings comes, there's only one day, and so there could be a lot of shifts on that last day. But what might be more practical is in the next Friday, this one adjusting from 65 down to that 36% as well. And so hopefully that kind of touches on some of those questions we got that, well, if you do have like a call on something like Netflix, high short-term implied volatility, there's a little bit of a rush. Well, your call that's expiring at the end of the year, well, it really hasn't gotten a lift in implied volatility due to earnings happening now. It's not really going to have a crush due to earnings happening now because, well, there's going to be an earnings announcement now. There's going to be an earnings announcement coming up in October for this. And then, of course, the next earnings announcement would be 6 months from now, looking at January on there. And so this would then expire right before the next earnings announcement and such. So you really wouldn't see that rush and crush from now. That said, generally, if traders are going to be trading options around earnings, they're going to specifically be trading options around earnings. They're going to be looking at this July 19th date, not this December 20th date from that particular perspective. So let's shift over, and there's a kind of a quick screenshot or a pair of quick screenshots I'd like to share with everyone. And well, first, this is the Bank of America one. I'm going to pull up. And this will give us the option implied move versus what the stock actually does. And we can see that we have that current implied move of 3.4% versus we see in the past, on average, 3.58%. So it's kind of expectations are a little bit less than on average. And in the past, the stock has only moved about 2.25%. So this kind of gets into different strategies and such. Now, if you have the expectation that you expected a bigger movement, you'd be an option buyer. You could buy an at the money call, at the money put, and if it does move more, profit off of that. Moves less, it's going to be painful on that perspective. And I'm actually going to shift over to Netflix to kind of build upon the chart that Troy was sharing, and we pull up the same exact chart, the same graphic, except for Netflix here, and we can see the current option implied move right about 8%, which is slightly less than the average over the last 2 years, which is right about, again, slightly less than what Netflix has actually done in the past, what its actual movement has been in the past due to earnings. So as we then shift back over here, we just pull up a quick blank chart. On Netflix. And Netflix is at $650 a share. Well, 8% of $650 is just under $50. And so let's kind of rounding a little bit to make the math easy. We'll drop this on here. And we can say 8% is actually about $52. And so maybe we go $605 down, apply. And we do 710 on the upside. So this is what the market's pricing in for Netflix's move at 8%. Now, if you're looking at it, you're going, well, I see there's a little bit of support here. What was resistance becomes support. I think Netflix isn't going to drop below that. And I think Netflix isn't going to go up above this level right here, because this was, its previous highs and such. There's a little bit of a strained look. Well, how much of a move is this? 631 from 656. That's about $25 up. 689 minus 656. That's about 25 down, 33 up. That's about half of expectation. So what could you do? Let me pull up the option chain real quick for Netflix. And this gets into volatility-based strategies. One other thing a trader can do is, I know it pulled up, a fancy screenshot from LiveVol, but to get kind of a rough estimate on what the option market's pricing from expected movement, you could also go and you could add the at the money call and the at the money put together. And so we see 655 at the money calls about $28, at the money puts $27. Well, adding those together, we get $55, which is really close to 8% that LiveVol is providing us. Some of that difference is, of course, going to be that there's movement between now and earnings, and there's movement from when earnings is announced and the expiration of this option and such. It's also being priced in this. But that could give you a very easy rule of thumb on how much movement's expected out of the at the money call and the at the money put to get that. It got us real close with that. Now, if you only expect a $25 move or $30 move, what could you do? Well, if you're to sell the at the money call and at the money put, we'd bring in about 55 bucks. This is selling the at the money straddle. Now, if the stock dropped $25, if you're right, well, the put would be worth 25 bucks. You sold the at the money call and the at the money put for 55. You get to put in your pocket. You get to keep the rest of that amount. Or if the stock goes up to 33, the call is going to be worth $33. You sold call and the put for 55. You get to put the remaining in your pocket. What's the risk? Well, what if Netflix drops to $500 a share? Well, all of a sudden, the at the money call and put that you sold for 55, well, that put's now worth 150 bucks. And you could be on the hook for some serious damages there if it really, really, really moves. So what a trader might do is, as opposed to selling the at the money options, they might go one standard deviation away. They're looking at, an option with delta closer to 15, 16, something like that. In essence, going where the market was expecting a $50 movement, that's where they might then start. And so let me shift here. We'll look at some wider strikes. We'll look at 600 to 720. There we go. And you could look at selling something down here. 600 you get $6, you get $7 for. The 710 you get $10 for. Well, you could do that and bring in $15, $17. Not quite the 55, but now if the stock does go up or down what the market's pricing in, you're still being profitable. And this kind of shifts things over to, always we'll talk about golf, that you can kind of tailor your risk, that some option trades are like a big wide par 5 fairway. You can slice it off, still be in the middle of the fairway, but you still have to have a follow-up shot. Other shots are like that, island green on 17, that you're either on the green or you're in the water. And doing something like this kind of widens that out, that, well, now it can really move and you're still at 100% gains, but you're not bringing as much premium. Now, what else could you do? Well, if you were to buy one of these options in here, maybe you bought a 610, sorry, you sold the 610, you could then buy wings further out to then protect you if it really, really does move. Of course, at the cost of you're giving up even more of your premium associated with that. And this is kind of some of the differences between a straddle and a strangle, and a butterfly versus a condor. That butterfly is a straddle but buying protection, and a condor would be a strangle but buying protection on that. And this is, of course, all on the basis that you expect less movement than the market's pricing in. Now, there's all kinds of different things between all of this, that maybe you're looking at this from this perspective and you're seeing this in general. I'm not trying to draw a nice trend line, but you're just seeing that we have higher highs, higher lows, that you don't think it's going to be up to 730, but you're thinking, testing the 700 price point could be within the realm of possibility. So you're bullish biased, but you don't think it's going to move up that much. Now, what then might your thought process be? Well, basics, there's really only 4 types of option trades you can place: buy a call, sell a call, buy a put, sell a put. But 2 of those are bullish, 2 of them are bearish. 2 of them are bullish on volatility, and 2 of them are bearish on volatility. Buying a call is bullish on direction and bullish on volatility. just single-legged, you'd buy a call if you expected a bigger movement than the market's pricing in upward. You'd buy a put if you expected a bigger movement the market was pricing in downward. Now, if you're expecting a smaller movement upward, you can simply sell a put. Selling a put is bullish and it's bearish on volatility. Selling that at the money put, now if it drifts up, you get to keep the entire premium. Selling an at the money call, it's bearish, but also bearish on volatility. And it does have its associated risks as well. If Netflix does move up to, to 700 or 680, but you spent $28 on the at the money call, well, 28 plus 656 is 685. If it's 680, 690, you're just breaking even if you bought an at the money call, where you'd have a pretty good profit if you sold the at the money put. That said, the complexity of option trading gets into being able to combine calls and puts, long and short. And so this is where maybe a spread might come into play. You could spread off some of your exposure. And so I do want to share this next thought real quick. And then I know Troy has a couple other things that he wanted to share as well. We have some other questions that came in. But this, maybe we look at, come here to the profit and loss calculator. Netflix. And we can say, we'll change this to spread. Going just beyond earnings. And we're going to look at buying the at the money call, the 655 call. And will we expect it to go up to, 690? We can then sell the 690 call and then potentially profit off of that difference there. Now, if the stock goes up to 690, and we'll say it's a 690 on Saturday, that way there's no time premium left. Well, what's happened? Well, now this is at expiration, and we'll have spent $14 for this option versus $28 for the option, and it's now worth $35. And we've had 130% return on our capital versus barely breaking even. And so with spreads can spread off your exposure to volatility if you're directionally biased, but then you're expecting less movement than the market's implying. If you're expecting more movement, you're expecting a $70 move, $80 move, $100 move, well, then potentially just being long the call is going to be your better bet. And there is some comparison I like to do between at the money, in the money, out the money calls. But before I do that, I don't want to take up all the rest of the time. I do want to give Troy an opportunity to share some of his thoughts and answer some of the questions that might have come in.
Yeah, Nick, we could do this all day. This is a great discussion, great topic. Again, I think visualization, you kind of read my mind with the profit loss calculator. I think this is a great tool to help us visualize what the chart's telling us. And when we're thinking about or considering any kind of strategy around earnings, again, we can use this tool. Let me go ahead and just share. We did get a ticker symbol request for ASML. We got that pretty early in the session. So I'm going to share that just for a moment here. And then if you got anything else you'd like to share as we get ready to wrap up, we can certainly do that. So here's the chart, ASML. This announces, I believe, Wednesday, the 17th in the morning, I believe, if I'm not mistaken. So again, this is a semiconductor name. I can go ahead and just double check that. Stock ETF profile. Yes, it's a semiconductor name. And we can see it's been in a very clean, well-defined uptrend. It recently broke out. It's been volatile. You see some big red candles, big green candles. So it's been kind of bouncing around here. But the idea is, okay, well, what if I think it goes a lot higher, or what if I think it goes a lot lower? What would be your strategy of choice? Might you consider an at the money straddle? Well, let's actually use the profit loss calculator to simulate that strategy. To go to a chain, again, always be aware that when you pull up a chain, be on the lookout for this blue E, because that can tell you, hey, earnings are coming up. If you weren't aware, you get caught off guard. Just make sure you're always aware that that's a concept. And so July 19th, that's this Friday. So that's the first expiration post earnings. Look at the IV 77. Now you might say, okay, that sounds like a high. We can use again the option stats. I can go ASML, and we can see this is very, very high. This is 95th percentile. This is just 30-day to expiration options, by the way. So this is, this Friday is only a couple days, but you can see short-term options are at a pretty elevated level, historically speaking. Can they go higher? They absolutely can go higher. Can they go lower? They can. Just be aware of what your context is. And so IV is high. We should know that. You're paying a lot for options. So if I was to buy, let's say the 1070, that's the closest one to this. I just loaded this now, and it said the total cost would have been around $71. That's 35.80 plus around 35.70. So about $71 or so. So with that in mind, what would we need to see by this Friday in terms of ASML's reaction to its earnings Wednesday morning? Well, we actually don't break even on the downside until we hit 9.99 on the stock. We don't break even intrinsically on the upside until we get 11.41. Let's zoom into our stock now and let's visualize those price levels. So if I go 9.99, this is the downside. I'm going to do another horizontal line, and I'm going to do 11.41. These are the break evens according to our calculator. You can see them right here. And we can see that's a huge range. Look at that. So let me ask you this. Is there a situation, is there a scenario where the reaction is just okay and it stays somewhere in this range? Absolutely, there's a scenario where that could happen. So the idea is just know the strength of your trade. For this trade to give you a large payout, there has to be a monstrous, monstrous move. The lower side, 9.99, that's right near a support level where it previously tucked back, it broke out, gapped higher. So that's quite a ways away. Now, folks, again, anything can happen, right? Could this thing gap substantially lower to 900, or could this thing push, quite a bit higher to the 1200s and further? Yeah, absolutely. But you have to ask yourself, what's the likelihood of that? And so, again, there's no necessarily better or worse trade. It's just be aware of the strengths and the weaknesses of your trade. The strength of this trade is if there are a monstrous movement in either direction. However, the drawbacks to doing this strategy is a lot of that seems to already be priced in. We just looked at the 30-day IV. It's 95th percentile. The IV for these specific options are in the 70s. It's very, very expensive. So unless you get a monster move, the strategy is just really not going to pay off. Now, if you were to take the other side of this, well, okay, that's actually an uncapped risk type of trade. So on a low probability, you do get a monster move, you would stand to lose. So, okay, if you're going to do that, might you use a different strategy with some type of a capped risk profile? You could do something like a short iron condor. Could you try to pin it and use a butterfly? Yeah, you actually could do it. You could use a regular butterfly, an iron butterfly. So the idea is understand your strategy, understand, okay, instead of just betting it's going to go in either direction, maybe I want to take it biased to the long side or the bullish side. Maybe I want to take a bias to the bearish side. Do I want to do a pure directional play? In other words, just buy a call, just buy a put. Be aware of the vol crush. But the idea is if you get the price move that's favorable, that could be a winning strategy. You could also use something like a spread. You could buy a bullish debit spread. You could buy a bearish debit put spread. You could do a credit spread to say, hey, I think it's going to stay under this level. Or you could sell a bearish put credit spread, I think it's going to stay above this level. So there's different trades, but as traders, we got to think about the trade-offs. What are we risking and what are we getting? What's the relative payout? And then what's the probability of success? We want to be careful of extremes. Lottery trade, right? Very low probability of success, huge payout. You're just not going to be right a lot. So it's just going to lose. It's probably going to help make you lose money versus the steamroller trade. You make a little bit, but you have a very high probability of success. Well, the one time it goes wrong, it could erase all your gains and then some. So the idea is there's some healthy medium in the middle where you try to have your cake and eat it too, try to have a good payout, try to have a low risk relative to your reward. So again, we want to try to have our cake and eat it too. We can think of different strategies, but we know vol crush is going to be a concept. What kind of price move do we get? What type of strategy do we want to employ? How is it going to pan out? And does it seem attractive? We don't have to trade every scenario. There's going to be times you might look at this and say, maybe I want to wait to see if this pans out. And maybe I don't want to trade. Maybe I actually like the stock and I want to own it for the long term. Maybe I might buy some of the dips, or as long as this trend holds, maybe I want to buy it. If this breaks, maybe I want to look at different levels and say, hey, I'm going to see if this level holds, which is that 999 level. So there's different thoughts there, but again, profit loss calculator, very, very helpful tool, Nick. Anyone considering an options trade, I think, is really going to be helped by using that just to play out different scenarios.
Couple quick questions that we got, and then I want to comment on. Maybe I have one last thought that I want to share with everyone. Is we're asked about iron butterflies versus long butterflies. We're also asked about dealing with condors and such. And I want to be kind of blunt with this, that a condor is a condor is a condor. A butterfly is a butterfly is a butterfly. That it doesn't matter whether you're doing, like with butterflies, you're doing calls, you're doing puts, you're doing calls and puts. They're all the same. They're synthetically identical. Now, that said, frequently doing like an iron condor versus a call condor versus a put condor, the strikes, the options might have better liquidity, because an iron condor, typically you're going to be selling the out of the money options. They're going to have lower premiums, tighter bid and ask spreads. Now, you could sell the out of the money call condor or the out of the money put condor, and I've also seen people that do that, and they're similar, but when they flip it like that, well, all of a sudden, the bid ask spreads are so wide that can cause problems from that particular vantage point. The same thing if it's calls and calls. Well, the call condor that the call spread they sold was out with money, pretty tight. The one that they bought in the money, well, that's kind of wide, and then might then run the risk of early assignment on their in the money call option, and so on with that. So that said, the one last thing I want to share with everyone is coming back to Netflix, and I have 3 different call options here on Netflix. I have an at the money call option. I have an in the money call option about that 1 standard deviation down, and I have an out of the money call option about that 1 standard deviation up. Now, the reason why I'm doing this, and I've adjusted prices a little bit to say, well, you have $6,000 and you're going to trade an option. So many traders I've worked with have gone, well, that $30, that's a lot for an option. I want a cheaper one. I'll trade a $10 one. But then they buy 6 of them and spend $6,000 on that. And so I've kind of negated that, where I've gone, 1 in the money option for $60 for $6,000, 2 at the money options for about $30 for the same $6,000, or 6 out of the money options for $10 a piece for the same $6,000. Or we could even add on to this and go, so many further out of the money options for $5 a piece and get the same risk here. But the point of this is let's take a look at this theoretical price column over here. And I'm going to zoom in a little bit on this to draw just a little bit more attention to this, and give me a moment while this zooms in. Let's see. And there we go. Shift over. That might have been zoomed in just a little bit too far. Let me back it back out real quick. And we'll shift back over to that particular tool. So this theoretical price tool, that's what's going to be important right now. And I've reset everything, so theoretical price should be about the midpoint, which is really about my evaluation price was, and the market shifted just a little bit since I put this on. But let's say we're looking at this Friday, and now this is shifting over, and let's then say there's a price change. Let's say we were right in our hypothesis that it would go up to $685. And we can even back this up. We're going to back this up one day so that it says that there's a day's left in this time premium. We're also going to say implied volatility value is at 35%. So this is in the crush down of this. And so there's going to be a little bit of time premium in this, but not much. So to speak, there's going to be one day left. Well, this goes up to 685, like we were talking about. What do these options look like? Well, this cheap out of the money option, we're in near 100% loss. What about the at the money option? Like we talked about, we're right about break even. But what about this in the money option? We spent $60 on it. It's now worth 80. We made $20. We've made about 33%. We've actually had a reasonable return on that, a leveraged return compared to buying the stock. What about if the market's just flat at 655? Well, now this at the money call, there's a little bit left in it. The in the money call still has the majority of its premium left. So risk versus reward, we can see some of these differences here. Now, what about if it does really take off and it goes up to $710 on here? Well, the at the money one is just about double, not quite. Same thing with the in the money one. So our returns are about the same percentage-wise on those two. And we got a bigger move than we expected. Well, look at this cheap option. It's only worth about $4. We're still losing money on it. So when does this cheap option really start to make sense? Well, what if the stock goes up to 750? Moves a lot more than expected. Well, now this cheap option is worth $40. We paid 10, made $30 off of that. That's a 300% return, where our at the money option only has a 200% return. Still pretty good. And our in the money option has about 150% return. So if we get a much bigger move than expected, well, now the out of the money option has a higher return on capital, which is what you're trading for. Where if it only moves a little bit or doesn't move, then the money option still has a lot of value left. Now, what if, and you might go, well, what if it drops to $500 a share? Well, now you're losing all that money you spent on that big expensive option, but as basis, you're losing everything you spent on the other ones as well. And so your net loss is this kind of the same on that. So really what the trade-off here is that And a lot of traders will make this mistake. They'll buy an option because it's cheaper because they have their expectations. You want to be sure that depending on your expectations, you're going to be profitable if you're right. Now, if you expect it to go up to 750, yes, that 710 will be the most profitable, have the highest return if you're right. But what if you're kind of right and only goes up to 715 on that? Let's also model back again this crush here. Well, it only goes up to 715. Well, that cheap option, you're at a loss still. Where these other options, even though they were more expensive initially, you still have fairly nice returns on them still. So be sure that you weigh this, and this tool, this profit and loss calculator, can be super, super, super impactful for this kind of trading, for trading on earnings, for modeling, which of these trades might have been better. And then this still comes into play that if this was your expectation at coming to 715, well, the better trade wasn't which one of these three options would you have bought, but the spread. You bought this one for 30, sold this one for 10. Well, now you're in this trade for 20. You're in a spread trade for 20. Your maximum profit potential, you spent 20 bucks and now the trade's worth 55. Now you've made almost $35 on that. $35 risking 20 versus $30 risking 30. Your return on capital is even better than with that spread. That said, Troy, I know we're 10 minutes past time here. Any last thoughts you have to kind of wrap us up?
Yeah, Nick, as traders, we want to be aware, we want to look for opportunity, we want to see, hey, is there maybe a skew or maybe a situation where we think a certain outcome is priced in and maybe unnecessarily overly favored? Again, there can be situations where reality meets expectations and there may not be an opportunity there, or the option market effectively prices in, what could happen. The idea is we need to be aware of the vol crush, aware that, hey, an earnings is a new fundamental data set that's a catalyst for the stock. There can be positive outcomes, negative outcomes, mixed outcomes, neutral outcomes, or any type of combination thereof. So again, we can look at the chain, we can look at straddle pricing, we can understand, hey, again, is there opportunity? We don't have to trade every single setup. There can be many times where you might evaluate several different angles and say, I don't really see an angle where I feel like I've got an advantage. And in that case, you don't have to trade. You can wait and see. And of course, make sure you're aware, is this just a one-off trade? Is this a trade that I'm looking to maybe segue into an investment? So, and maybe you want to, a great exercise I would encourage everybody to do is, without putting real money at risk, take a hypothetical strategy, put it in your profit loss calculator, and then wait till earnings comes out and wait to see what the actual outcome is. You get to kind of play around a little bit. And again, with no money at risk, you can use the profit loss calculator and simulate, okay, here's a situation where I might be a little bullish, I might be a bearish, I might pick a straddle, I might do a short iron condor, whatever the case. You can do that and you can kind of see over time how much success you might have had in a hypothetical situation. Of course, it is just hypothetical. So I would encourage you all to do that. If you haven't, it can be a great exercise. It can be a great learning experience. And if you're ever thinking about employing some of those strategies, it can give you a couple different occurrences under your belt that could be, again, very helpful if you ever consider perhaps approaching the real thing. But thanks so much for your wisdom, Nick. I always appreciate, you showing us all those different concepts that we can, again, use to help us with our own trading. Folks, there's lots of earnings coming up this week. Make sure you don't get caught off sides. Know what you own, know why you own it. Always have a plan to manage risk. Always think about what can go wrong, not just what can go right. We seem to sometimes ignore that. We're human beings. The psychology, we avoid pain. We only pursue pleasure, but we got to play defense. So always think about what could go right. Always think about what could go wrong. You have to understand there's opportunity, but there's also risk. You got to manage that risk. So take care, everyone. We hope to see you again soon. I'll be back for our technical analysis class at 2:30. Nick, I'm sure you've got a lot of other sessions coming up there as well. Take care, everyone. We'll see you hopefully again soon.